you can profit in both up and down markets. Like, people don't have to sit on the sidelines if the market's going up or if the market's going down. You may just have to adjust your strategy, right? And that goes back to things always change.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So hey, welcome back to Accelerated Investor. I am so excited to be with you as always. For all of you who have been sharing this on social media, telling your friends about it, telling fellow investors about it, entrepreneurs about Accelerated Investor, joining our Accelerated Investor Facebook group. I just want to thank you for including me in part of your journey, part of your life as an entrepreneur, building your lifestyle business, your cash flow business, to support you and really provide an opportunity to live a life on your own terms. Today, I have a special guest. His name is Rob Swanson. He's the CEO of Freedom Soft. He is a 20-year real estate investor with over 20 years of experience. He's a close personal friend. I first met Rob over 10 years ago at multiple real estate seminars. He's spoken on my stages at my live events, and we continue to share at mastermind groups. He's just an amazing investor. To give you some background about Rob, he is the CEO of Freedom Soft, which is one of the world's best automation tools for real estate investors. He has done hundreds and hundreds of fix and flips, wholesale deals, owns a robust cash flowing rental portfolio, and is the author of an upcoming book about how to profit in real estate during the upcoming recession. And that's going to be the major talking point of today's interview. Rob, thanks so much for carving out some time for us and our family here at Accelerated Investor. How you doing today, bud?
Hey man, I'm doing awesome. Thanks for having me. This is going to be super fun. Appreciate it, buddy.
Yeah, you bet. So Rob and I, kind of parallel kind of paths. We've been investing for a long time. Rob is really a huge fan of automation strategies and tools, systems and process, to the point where he's actually franchised his model and has sold franchises on how to invest in real estate, with the backbone of that franchise being his software, Freedom Soft. We've been a big affiliate of his for a long time. So Rob, tell everybody a little bit about right now in 2020. I love to ask my guests, what are you currently working on, literally like this morning or tomorrow, before and after this podcast? What are some things that excite you about real estate, and what are you currently working on that gets you going?
Yeah, so good question. So where I'm at today, Josh, I look back over a 20-year career and I say, okay, what's been happening for 20 years? The good, the bad, the ugly, the ups, the downs, the sideways, and how does my experience parlay into what we're doing today? And that kind of brings me to what I am doing, and that is today we're buying for cash flow. I think that the market is up. We know that across the country. The economy is doing well. Things are moving along nicely, but we're starting to see the sprinkles, right? We're starting to see the advertisements for the no doc loans again, and the easy financing, and like the easy money, that liquidity that floods into the market that we've seen over the last three housing market crashes, right? Back in 73, 74, 90, 91, 2007, 8, and we're starting to see it again. It's a typical 17, 18-year cycle ever since the dollar was taken off the gold standard back in the 70s. And and debt was introduced as the primary sort of driver of currency. And so here we are today. I think we're at nearing a peak. I don't know that we're at the peak. And we'll talk about how this, plays out differently. There's a national economy, but then there's, every market is different. But today, I think we're up across the boards, and I'm buying very conservatively on cash flow. If it doesn't cash flow, I'm not interested. And I'll give a little precursor into some of what we'll talk about. The reason why is we have seen in the last 3 housing market crashes, those timelines that I just talked about, that rents, predominantly on single-family homes, but also on well-positioned multifamily assets. Rents on single-family homes and well-positioned multifamily assets go up in a crash. So all of this equity, the fake money that everybody is so excited about, crashes and evaporates, and the real money, the cash flow that comes in and goes into Rob's hip pocket National Bank, goes up. And we saw that in the last 3 housing market crashes, and I don't expect the next one to be that different.
Right.
Yeah, so that's where we're at.
Fantastic. So investing for cash flow is where it's at. And as we kind of got ready for this interview, we've started to move our assets from fix and flip investing, fix and flip lending, buying and flipping, to buying and holding. Matter of fact, we're even lending more on smaller and smaller and smaller rehabs to our borrowers for the purchase of acquisition and basically what we call stabilization, not necessarily massive flip rehab projects, not $50,000, $80,000, $100,000 rehab budgets, but $8,000 and $10,000 and $15,000 and $22,000 rehab budgets for the sake of stabilization to immediately refinance into long-term financing. So much so that we now do the acquisition financing and the 30-year permanent financing. We have a couple different crowdfunding platforms and life insurance companies that love that long-term paper. So we've begun to move that way as well. Getting ready for this, Rob, you told me, about you saw the crash coming of 2008, 2007. You were doing fix and flips back then, and you made a $10 million mistake, something that you learned from, 12, 13 years ago. So let's talk about that. What did you learn from the 07, 08 crash of what you were doing then, and how is that also helping you to position yourself this time around?
Yeah, so it was actually a $30 million mistake. What we did back in 2008, I put a $10 million real estate fund together. In 2004, I started tracking markets. I've done a lot of virtual investing, investing remotely across the country. Probably invested in 20 some different states and 35 or so different cities across the country. And so we started tracking markets. We were tracking the weekly performance of over 8,000 cities and 43,000 zip codes across the country. And what we could see was this tipping coming. It wasn't, I'm not an economist, but I was certainly looking at the supply and demand triggers and kind of how liquidity in the market was affecting things. And so I sold out of my real estate portfolio in about 2006, early 2007, good timing. And when the market went into free fall, it was, it was about August 13th of 2007. I got a phone call from a buddy of mine, and he said, "Hey, my business is gone." And I said, "What do you mean, man?" It was like a Wednesday morning. And he's like, "Wall Street stopped buying all the debt. August 13th, 2007, the liquidity just evaporated out of the market." And so
Wow.
When that happened, everything started to free fall. Prices started to drop. Everything started to happen, and I saw it as an opportunity. The old saying, when there's blood in the streets, go.
Right.
And so I started to put together a fund at that time, and I ended up with a $200 million capital partner out of Stamford, Connecticut. They carved off and gave me a tiny little $10 million tranche of their money and said, go to work. And we did. We went to work. We bought and we sold and we fixed and we flipped. And it was great. We made a lot of money doing it, and we built a lot of systems, and it was a wonderful time. But Josh, here's the thing, man. All of the old, crusty, chain-smoking, hard money lender guys and note buying guys in town here that I knew were all telling me, Rob, you're young, you got access to the money. Here's what you do, kid. They're telling me buy everything you can get your hands on, board them up, disconnect the utilities, and then just rehab them as you can get to them and put tenants in them as you go. But they said, do not let construction hold you back from buying. What did I do? I reserved the right to say, but Bernie, I don't know, man. This one feels different. And he's like, what do you know about feeling
What
different?
do you know, young man?
Yeah, what do you know? So I did it wrong. If I would have taken the $10 million, spent every dime, bought everything I could have, I would have, with no work, I would have turned that $10 million into $40 million. So it was a $30 million mistake. And it really got me understanding and focused when I look back now and realize, man, wealth is built in real estate by buying and holding real estate. It's not built by flipping real estate. You make good money. You're a high income earner flipping real estate. And it's wonderful. And it sometimes gives you the cash to just go pay cash for another income property. But the true wealth is built by buying and holding.
No doubt, no doubt. And so today, and really for the past couple of years, you've been positioning yourself for that. You've got this book that's going to be coming out in the upcoming year about how to profit during this crash based on, again, the lessons that you learned from the 07-08 crash. And I'm looking forward to reading that when it comes out. I know that you do have like a almost like a pre-launch registration. It's cash. Give me that website again in case people want to go and get kind of pre-registered for that.
Yeah, you bet. The book is called Cash In: What to Do Before, During the Next Housing Market Crash. And Josh, I've intentionally, I've been talking about releasing this book for a couple of years, but I haven't felt like the timing was exactly right. And I keep seeing different things, and I've gone back and I've added and I've tweaked on the book. But cashinplan.com, people can go there and they can get on an early bird release. And, when I talk about what to do before, during, and after the next housing market crash, it's taking my experience over the last 20 years and saying, what did I do right and what did I do wrong? What have I heard along the way? What have people told me along the way? And how do I take that knowledge plus the actions that I've taken and turn that into wisdom that I can share with others? And there's 5 market ground rules that I think about when I'm talking about a housing market crash, or the housing market in general, if you will.
Sure.
Number 1, every market is different, right? There's a national, financial currency. So there's a global national economy, but then every market sort of reacts a little bit differently, different price points, different economic stabilizers, and all of those things. That's rule number 1. Every market's different. Rule number 2, markets always change. One of the things that I'm sure you've learned in real estate is that the common and most common thing that is always the same in real estate is that things always change in real estate, right?
No
So
doubt.
rule number 2 is markets always change. Rule number 3 is you can profit in both up and down markets. Like, people don't have to sit on the sidelines if the market's going up or if the market's going down. You may just have to adjust your strategy, right? And that goes back to things always change. Number 4 is some strategies work better at different across the cycle. And so if you find yourself sticking a square peg into a round hole and things aren't working, ask yourself, is what I'm trying to do today aligned with the market positioning that we're at? And number 5, knowledge plus the correct action allows you to build wealth faster. If you understand speculative market timing, but if you can understand market timing and how to apply the right strategies in the right positioning of the cycle, you can do a whole lot better. Goes back to my $30 million mistake.
Right. So love it. So every market is different. Markets always change. You can profit on up or down markets. Strategies work different and depending on what part of the cycle that we're in. And knowledge plus action equals building wealth faster. So love those ground rules. So as you apply those ground rules to the before, during, and after the crash, let's assume now that we're before the crash and and the during might be 6 months to 2 years away, depending on who you talk to. We're before the crash. So how do you applying these market ground rules to now, assuming, again, markets are different, which is, rule number one, and markets change, which is rule two. But there are, as an overall national economy, we are in a big bubble together, understanding that local markets change, but we're before this crash as a nation. What specifically are you working on, and are you teaching your franchisees and your students? What are some specific tactics to be working on right now before the crash? What are they doing? Are they hoarding money? Are they buying rentals? Are they buying inexpensive properties, maybe multifamily? Are they getting rid of fix and flips? Help me understand, what are some tactics there and before the crash that you're working on?
Yeah, great question. So right now, today, before a crash, as we're in, and the real estate cycle goes up and it goes down and it goes up and it goes down, and so we're in that riding it up. We're not at the peak. We're not over the peak, but we're riding up somewhere along the wave. And so what I teach people to do in this phase of the real estate cycle is to buy conservatively on cash flow, and do that in what I call price stable markets. So there are two types of markets that I think about as it relates to a housing market cycle or a housing market crash. There are boom bust markets, and there are price stable markets. And so I'll give you an example. Denver is a boom bust market, right? Denver skyrockets up and then it crashes. It skyrockets up and then it crashes. That's the cycle, right? Seattle is a boom bust. Las Vegas was a boom bust. Phoenix was a boom bust. Lots of places in Florida were boom bust. A price stable market is like Memphis, Tennessee. So I buy a lot in Memphis, Tennessee. Memphis, Tennessee is, if you look at the price and if you look at the rents from today over the last 30 years, they're not that different. Yeah, every time we hit that upward curve, there's a little bit of a drive up, but when it crashes, it can crash. And also the price point is so much lower that even if you get a 20% drop in market value in a crash, that represents maybe $10,000, maybe $15,000 in total value lost. So today, in an upward trending market, I like to buy for cash flow. It's got to be net positive cash flow in a price stable market.
In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast. It's probably stuff in the Midwest, maybe the Southeast, excluding Florida, certainly Texas, places in the middle part of the country. The further you move west, the more closer you get to the coastlines, the more those boom and bust markets are happening. People might talk about Texas because there's just, again, fairly stable market, but there's also so much population migration moving there. I would imagine that's pretty price stable, although some of the big cities, Dallas or Houston, could have a larger fluctuation simply by their pure size and some of the speculation that's going on there. But yeah, I love to invest in the Midwest. It's not the sexiest play, but it's, again, a stable, smart play. I love Cleveland, Indianapolis, Kentucky, obviously Memphis. Memphis, some of those types of places are on the board. And I love the fact that and again, if my listeners are really listening, and I know they are because they talk about it and they reply to us, so many of the guests we've been having lately, whether they're investing in mobile home parks or multifamily or SFR, single family rental portfolios, they're all saying the same thing, right? Buying conservatively for assets that cash flow very quickly. They either cash flow right now or they'll cash flow in the next 30 to 60 to 90 days after you do a small stabilization. Not something where you're doing ground up construction that's not going to cash flow for 18 months. Don't do that right now, especially in a boom bust market. So Rob, any other nuggets or pieces of advice on investing before the crash, before we move on to during the crash?
Yeah. So I always like to think about kind of that before the crash area. You've got early before crash and you've got later before crash. And what I mean by that is there's a transition point at some point in the bottom of that dip, right? There, and you start to ride back up. You're early, you're before the next crash, but you're early. And that's where you really have the opportunity to cash in. And as we kind of talk through the peaking over during the crash, and then what do you do post-crash? We're going to go post-crash. We're going to talk about that after the crash, on the drop down, and then on the rise, on that early rise back up. So yeah, we'll get there. We keep the conversation going.
Yeah. So almost even within these three cycles, before the crash, during, and after, you've got two mini phases in between each. You've got early before the crash, and then closer to the upcoming crash. Then you've got early in the crash, and then late in the crash, and then after the crash, the early recovery and the later recovery, which is great. So let's talk about during the crash, right? Which is what many people are probably fearing is, am I positioned to survive the crash? Like when the crash is, and we're actually into it, which, by the way, we're not even going to know we're into it for probably a month or two or three until we're actually into it. The market economy, the data doesn't come out in real time. It usually comes out 30 to 90 days past due, and you're like, oh my God, we're in a recession, right? And then everybody freaks out. So let's position ourselves before the crash, which we just talked about. Now let's assume we get the news, it's a year from now, and they're like, yep, we're in a recession, and the data proves that the economic growth is actually stagnant or going negative for the past 30, 60, 90 days. All of a sudden, it's during a crash. What are we doing now, based on your experience, to be positioned well during the crash, to profit and to be successful and survive, and not only survive, but thrive during that time?
Yeah, so there's a couple of things. There's 5 things that I kind of try to tell people that they've got to understand about moving into a crash, right? So before the crash, everybody's euphoric, everybody's happy, real estate is awesome, everything's going well. And then all of a sudden, we get into this slowdown period, everybody panics, we get into this kind of crash, bubbly area, and everybody starts to really kind of lose it. And so 5 things that I think help people navigate the crash. Number 1 is understand this: bankers make markets and bankers crash markets, right? Bankers make the markets and they drive up the values. It's about liquidity. It's about availability of financing and funding in the market. That's what helps the market go up. So if you understand that the crash in real estate, in housing, is tied to the availability of funds, you can kind of watch what loan products, what options are out there, what's happening in the financial market to say, are prices going up because of easy liquidity? The second thing is that, number 1, bankers make markets and drive up values. Number 2, there's those 2 types of markets, the boom and bust markets and the price stable markets. But number 3, and this is a big important thing, there are 3 converging storms that in the last 3 housing market crashes, and again, Josh, going to the 70s, the 90s, and then the early 2000s, right, or late 2010s, 3 things converge that drove that crash. Number one, there was a presidential transition. Okay. In each of the last 3 housing market crashes, there was a presidential transition. That presidential transition triggered, number 2, financial policy changes. Okay.
Wow. Okay.
And number 3, stock market turmoil ensued because of all of this happening. So 3 things came together in the last 3 housing market crashes: a presidential transition, financial policy change, and stock market turmoil.
Wow. I mean, I look back to 2007, 2008. You have the move from President Bush to Obama. Financial policy change along with that. You know, President Bush had that big push for everybody should own a home. Homes should be affordable. They pushed on Fannie Mae, Freddie Mac, and FHA to expand the underwriting criteria to make homes more affordable. And then stock market turmoil happened for many different reasons. Stocks were overpriced. Also, going back to your point number 1, which is the availability of funds when the market crashed and the funds, literally, like your buddy said, my business is gone. There's no secondary market to buy this paper. That not only happened in real estate, but it was happening everywhere. It was happening to every business where their lines of credit, their ability to borrow was constricted. So they can't buy inventory. They can't make product. They can't build their factories because there's no money in the system. I remember all that without you. The fact that you pinpointed those 3 are just, they jump out immediately because we lived through that crash.
Exactly. Yeah. I mean, I was an active investor during that time. I remember one day I had a line of credit out that I was using to buy and renovate, properties. And I remember waking up one day and that line of credit was tied to an operating account that I had for my business. And I remember waking up one day and this operating account being like wiped clean. Like there was no money in it. And I'm like, what? I'm like calling the bank and I'm like, hey, I think you guys maybe made a mistake because, there's supposed to be a lot of money here, but it's not there. What's happening? They said, oh no, we've called all our lines of credit. And because the line of credit was tied to that bank account, they legally had the right contractually to just wipe the money out of the bank account and pay off the lines of credit. It was unbelievable. And so that brings me to number 4, which is bankers crash markets. Bankers make markets and bankers crash markets. Number 1, they make it. Number 4, they crash it, right? And so if you remember a minute ago, I had talked about my buddy in August of 2007. Well, I remember that phone call so vividly. And if you go back and do some research, the Federal Reserve actually published a report in August of 2007. Get this, August, same dates. They published a report that said they now recognize that banks don't have enough liquidity to function. So liquidity, Josh, is the driver of a housing market crash. And it just lines up so perfectly when you take some time. I took the time because I looked back and I said, okay, I made a lot of money in the crash. I did well in the crash, but I missed the big opportunity. And why did I miss the opportunity? And it was because I didn't understand what was happening underneath the surface. And I was playing on a very surface, hey, this is really good, I can make money opportunity. And I didn't understand below the surface. And I'm like, I'm going to go study this and figure it out because I'm not going to miss it the next time. And so that brings us to number 5. Yeah, here it comes. Number 5 brings us to lending stops, foreclosures skyrocket, and people rent. So if before the crash today, you're buying conservatively for cash flow, and the crash happens, and lending stops, foreclosures go up, and people now are forced to rent because number 1, the financing to buy isn't available, and number 2, they got foreclosed out of their house and they need a place to still live. The demand for rentals goes up. And so if you're in single family homes and well-positioned multifamily, you're positioned today to take advantage of that rising rent and that increasing demand. It's just a no-brainer.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. Yeah, that is phenomenal. And I love how you're referencing back all of these real life situations that actually happened. You know, the financial reporting from the Fed saying there's not enough liquidity, and then bang, banks start calling their lines of credit due because of that, trying to create more of a balance sheet for themselves, more of a cash cushion, if you will. I remember sitting thinking, all of a sudden, there's not liquidity for people to get loans anymore. The lending criteria got tighter. Credit scores had to be way higher. The amount of money in the bank had to be way better. The amount of stability in their job had to be way better to qualify for a loan. And I do remember we flipped a ton of properties still. We were doing short sales back then. There were still lots of buyers for our short sale properties, but again, only the best of the best borrowers because the liquidity wasn't there. People say, oh, they stopped lending. Well, the truth is they didn't totally stop. It just became so much more tight to actually get a loan. And that's why, as you said, foreclosures skyrocket and people rent, because even if you have, let's say, a decent job, but you've only been on the job for 1 year, in a crash, they're going to want you to have job stability for 2 years or more. In today's economy, you might be able to get a loan with a 620 or a 650 credit score, which is not bad. But in a real tight lending market, they want you to have credit score of 720. So those people that are on the fringe, that are on the gray area today, if they're still getting loans, and they're not like subprime, totally horrible buyers, they're decent buyers, in a retracting economy, they're only lending to the best of the best of the best. So even the let's call them B-class credit or B-class borrowers, they become renters, right?
That's right.
Even though in today's economy, they would be a normal house buyer, which is awesome, Rob. So again, let me just feed these back. So number one, things to understand during a crash, understand that bankers make the market. Number two, be aware of those boom and bust markets versus the stable markets. Number three, the three converging storms, the presidential transition, which is exactly where we're at, potential policy change, which is exactly where we're at, and stock market turmoil, which everybody keeps talking about. Is there going to be a Democrat, Republican, those types of things. Number four, bankers crash markets. Again, liquidity being the main function. And then number five, lending stops, foreclosures skyrocket, and people rent. And now all of a sudden, even if you bought a rental property today, and again, in your example, Rob, earlier, you lose some of that balance sheet or paper equity. Your paper equity is down because prices are down. Your rents go way up, and that's what really matters, right? Is the ability to cash flow during that recession. So love those 5 points. So tell us about what happens after the crash. Then what?
Yeah, this is where it gets fun, man. So a few things. So somebody could argue and say, okay, but if the market is already high and we're expecting that the market's going to drop and go down, even if we're buying conservatively on cash flow, now all of our capital is high up and we can't take advantage of the bottom of the market, and buy low. Well, here's why you buy conservatively on cash flow. And this is where the strategy starts to become a strategy, and where we tie all of these understandings, these proven historical things together, right? So we've established that demand increases and rents go up. And so if rents go up as the fake money, the equity crashes and evaporates, what do you think you could do? How can you force appreciation in a free fall market? Well, you can tie the value of your investments to the cash flow. And what I'm talking about here is selling owner financing, because rents just went up, and rents, cash flow, the income is what drives an owner financing sale, right? So if you can tie the value of your real estate in the free fall to the rising demand and the rent, you can actually force appreciation, not a bank value, not a bankable value, but a market owner financed value. So now you've gone from owner to banker. You've become the banker, right?
Okay.
Now you have paper. And let's bring this full circle. You now have paper, and you sold the paper at a premium. Even though the bankable value is going down, you sold it tied to the rising cash flow. So you've established this forced appreciation on your assets. You've taken the position of banker, you've sold off the paper, or you've sold and created paper, and now what do? Well, what did we say created this whole thing, right? Bankers created it, lack of liquidity, stock market turmoil is one of them. You got all these stock market guys that have jumped out of the stock market, and the last thing they want to do is own real estate. But what do they want to do? They want to own paper, cash flow, something tied to some asset that can be insured. It's got income, it's got stability. And so you can take your paper that you've now created, sell it to all these frustrated stock market guys, right, who just got their butts handed to them.
Right.
Get your liquidity back out, and then as that free fall continues to go, you go take all your liquidity and buy at the bottom of the market and then ride it back up. Buy and hold at the bottom and ride it back up. That's how you cash in. I love it. You never have to sit on the sidelines, but you've got to be smart, and you've got to do some things that most people just wouldn't do.
Right. And you got to have enough foresight to be making moves now in the before the crash, which is exactly where we're at, and we're at the latter half of the before the crash, because the crash is not 10 years away like it was in 2010 or 2012. It's months or a year or two away, and be able to do that. And this ties in so well, Rob. Our philosophies are very much the same. We've pivoted from a couple years ago, as you know. We were huge into fix and flips, huge into fix and flip lending. We had a fund. We were doing dozens and dozens of big fix and flips a year, cashing in $50,000, $70,000, $100,000 profit checks. Had an entire training course called 40K Flips around it. All of that stuff is sort of seasoned out. And people ask me, well, Josh, how come you're not doing big fix and flips anymore? You were the guru. There's so many gurus out there doing fix and flips. Look, it's because I'm not married to a strategy. I'm married to my wife and children, right? Who I want to provide for. I'm not married to a technique to make money. What I'm married to is the pivot. It's the change. It's being It's being flexible with what the market is giving you.
Yep. A market gives and a market takes away.
That's right. And so, Rob, this is phenomenal content. I know you've delivered this in keynote addresses before, so I really want to thank you for sharing this with my audience at Accelerated Investor. As we kind of round third here and kind of head for home with this interview, are there any other points or big takeaways or things that you'd like to just kind of pass forward as we get closer here?
Yeah, the only other thing that I want to do to kind of bring it for people is to recognize that when you're buying in that before and during the crash kind of phase, right, where we are today, and you're buying in a price stable market, you're doing that because number one, the cash flow is better, and number two, the price variations even in a crash are not that great, that it allows you to sell that owner financing. Because with all of the demand for rent, most people that just owned a home, got foreclosed on, and now have to rent, they would rather own than rent, but they can't afford or they can't get the financing for the ownership, right? So where they are now is owner financing. A lot of sense. When you create that paper, sell that paper, get your capital back, and then go into the bottom of a market and ride it up, you're transitioning from a price stable market into a boom bust market. And that's one of the key factors. Today, you should be buying in a price stable market. In the bottom of the crash, after the crash, you want to be buying and holding in a boom bust market, because a market that has the historical trend of significantly appreciating. Right. That's a key to the market's understanding piece of the strategy.
Yeah, and this is where, we talked about boom bust, or you could say appreciating or depreciating markets. If you look at all of the capital that flowed into real estate in 2009, 10, and 11, and all these private equity funds, hedge funds, venture capital companies that all of a sudden became lenders and buyers, companies like Blackstone and Homes for Rent, these companies that now have 30,000, 40,000, 50,000 single-family rental units. What did they do that Rob just described when it came out of the last crash and they were, 2009, 10, they all bought in boom bust markets. They bought in Nashville, they bought in Charlotte, they bought in Florida, they bought in California, Seattle, Nevada, Vegas, Phoenix. And what's happened over the last 10 years? They've seen all that appreciation happen, and to a little bit of a degree now, you're starting to see them sell off some of those assets. They're liquidating some of, not all of them, but some of their assets at what would be the top of the market. It's really, really genius. And Rob, I love how you've tied this all back to the last cycle and how we can profit going into today's cycle. Again, guys, the website is Cash In Plan. Like the word cash, the word in, the word plan.com. Rob's going to be coming out with this, how to profit during the next recession, how to be ready before, during, and after the crash. If you want to get some of that pre-launch content and some of Rob's material, visit cashinplan.com. Rob, you absolutely brought it today with tons of amazing information to help us be profitable no matter what the cycle. Thanks so much for being here, brother. I appreciate it a lot.
Absolutely. You got it, man. Thanks.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.